We are all suffering from a mammoth hallucination. You think, I think, we think the stock market is a reflection of the economy. Now, it happens every single month. The CPI print comes in hot, unemployment rises, a bank in California implodes, someone pays off someone else, I don't know. And what does the S&P do? Does it crash? No, obviously not. That would be too simple, right? It rips to all-time highs like a drunk at the open bar. You look at your screen, you look at yourself, you look at the news, and you think, this makes no sense. The world is burning. Why is my portfolio up 2%? What's going on? It makes perfect sense, boys and girls. You just don't speak the language, or you're not fluent in it yet. You are speaking economics 101, where everything is in perfect equilibrium and where everything makes sense in a vacuum. The market is actually speaking liquidity plumbing. The reason stocks rally on bad news isn't because the market is stupid or irrational or rigged. It's because the market is a forward pricing mechanism for policy intervention and how the fiscal trajectory and the monetary stance changes thereafter. Today, we are going to perform another autopsy. You guys must be sick of me performing autopsies. And the autopsy is going to be on the bad news rally. Why does it happen? I'm going to show you the mechanical gears, the dealer gamma, the CTA flows, and the volatility suppression that turns a disastrous economic headline into an ungodly, unconscionable, inexplicable green candle. My name is Justin Banton. This is the House of Trade. Like, share, subscribe, if you'd be so kind. So, we are going to cover why short sellers are actually the fuel for every rally, why option dealers are mathematically forced to buy the dip even if they hate it, and why the credit market is the only truth teller in this room, as well as the bond markets. One of the same thing, right? By the end of this video, you'll stop shorting the headlines and you'll start trading the liquidity, start trading the plumbing, start seeing the mechanics for what they really are. Like looking into the matrix, but if the matrix were liquidity, right? I guess the matrix is a liquidity in one like existential way. Anyway, let's get one thing straight right before we start. You are trading based on what you see on CNBC or Bloomberg. Now, if you are essentially driving a car looking out the rear view window. Let's introduce our narrative device for the day. Our narrative device for today isn't a person, it's an idea of the addict. Imagine the global economy is like an addict, a junkie, right? It's been hooked on cheap money, zero rates interest rate policy or ZIRP for 15 years. Now imagine that bad news, like a recession scare, a hot CPI, a job market collapse, as the withdrawal symptoms in this addicted analogy, right? When the addict starts shaking and sweating, what does the doctor do? He prescribes more of the monetary methadone, right? In financial terms, we call that quantitative easing, or rate cuts, or fiscal adjustments, or window guidance, or whatever acronym that comes up, TINA, TARP, whatever they had to invent to convince you that it's QE, not QE, right? Now, here is the first law of addict market mechanics. The market does not trade the present reality. It trades future reaction functions of the central bank and where the spigots of liquidity come from. When the unemployment rate jumps, you see recession. The algo sees rate cuts are coming, monetary largesse is coming, looser conditions are coming, easier credit conditions are coming. Bad news for Main Street is fantastic news for Wall Street and for us traders if you know how to position yourself, because it means the cost of capital is about to drop. The hurdle rate for everything is about to drop. Zombification of the economy and entities are able to flourish bountifully. Think about the logic here, right? If the economy is booming, what does the Fed have to do? Keep rates high, right? Maybe hike them even. That sucks the liquidity out of the room. That is like the party ending. Someone putting the punch bowl away and saying, hey, you don't have to go home, but you have to get the heck out of here, right? But if the economy crashes, what does the Fed do then? The Fed has to begin panicking. They have to print, they have to inject, they have to lower rates. So when you see a horrific jobs report on the NASDAQ is rallying 300 points, don't be confused. That is the sound of the market front-running the inevitable rescue package. They're not celebrating the job losses. No, that would be macabre. They're celebrating the return of the punch bowl, the return of the methadone, the return of the structure that enriches them and does it in an easy and easily accessible way, right? It's like cheering for your house to catch fire because you know the insurance payout is actually worth more than your crappy furniture. Like, think of it like that, right? But let's get technical, because Fed hopes aren't enough to move $1 trillion market in 1 millisecond. It's just not enough. We need a mechanical, heavy hitter, a huge buyer, a huge market interactor, a huge interloper. Enter the CTA. They are called Commodity Trading Advisors. They are trend following robots, essentially. They don't care about earnings. They don't care about war. They only care about price momentum. Robust price action, tradable price momentum. Here is the setup that crashes and catches 90% of the retail traders offside. Leading up to a bad news event, everyone knows it's coming, right? The hedge funds are smart. They aren't waiting for the Bloomberg terminal to flash red. They have positioned themselves short weeks in advance. The market is heavy. Everyone is bearish. Sentiment is duly in the toilet, right? Then, all of a sudden, the bad news hits. Bam! CPI, terrible. Jobs number, terrible. ADP, terrible. Payrolls, terrible. The retail trader screams, I knew it! I knew it! The economy's falling apart. And what does he do? Or what does she do? They sell. But what do the hedge funds do? They are looking at a sell the rumor, buy the news event. Textbook. It's textbook for them. They're already pre-positioned in this market and they have a predisposition to take you for all you're worth. Since they were already short, to take their profit, they have to buy to cover, obviously. So think about that for a second. Just the mechanics of that. The first reaction to bad news by the smart money is a buy order. Now, if that's not changing everything in the way you're thinking, I don't know what to tell you. That triggers a cascade, right? The price ticks up instead of down. Now the CTAs, who are those trend following robots that I spoke about before, they see the price cross a moving average. Their code executes buy, buy, buy. Now the retail shorts get squeezed aggressively. They panic and they panic buy to close their losing positions, right? So you get a vertical green line on the worst news of the year. Why? Why, you ask? Why we all ask, right? Because the market was too prepared for the disaster. It was priced in. The price discovery wasn't serendipitous, right? As the old trading adage goes, a market that cannot go down on bad news is a market that can only go up, and vice versa. A market that cannot go up on good news is a market that's destined only to go down. So now we really have to start talking about the dark, mystical, cryptic, recondite dark arts. If you want to sound smart at a cocktail party, or increasingly at an alcohol-free party, or just, alienate yourself from your lover and your friends, start talking about dealer gamma. Believe me, I've tried it before and it works. This is the single most important mechanic in modern markets, and that's why I talk about it so much. You must be so sick of it, my 4 viewers, me talking about dealer gamma. Nobody really talks about it because it's complicated and it's a bit boring, but I'm gonna try and make it simple. Okay, let's break it down. Market makers. The banks that sell you options are not in the business of gambling or giving things away for free. They are in the business of collecting fees and premium. If they sell you an option and the market goes up, they lose money, so they have to hedge. We've been through all of that before, right? When the market is in a positive gamma regime, which usually happens when volatility is suppressed and things are going up, dealers are mathematically forced to buy the dips and sell the rips. They act as a shock absorber. We've been here before, I've spoken about it. So how does that lead us on to the news event leading to a rally when it's the most apocalyptic news ever? So imagine a bad headline hits, GDP misses expectations, the S&P drops 20 points, retail traders panic, but the market maker's algorithm looks at it and it says, hey, look at my book. Our delta is off. We need to buy futures to re-hedge right now. And what's dangerous about this is that it's not an individual doing it. It's completely automated by a high-functioning, co-located bot that's worth more than mine and yours existence put together. So precisely when the market should be crashing, the biggest whales in the ocean are forced by their risk models to step in and buy billions and billions of dollars of exposure. They cushion the fall. The selling's going to dry up and then the squeeze begins in earnest. This is why bad news often feels like it hits a concrete floor. You aren't fighting investors, you are fighting mathematical hedging requirements of the biggest banks, the biggest shops, the biggest prop firms, the biggest everything, the biggest hedge funds on Wall Street. You are bringing a knife into an algorithmic, algebraic, digitized gunfight, right? That's what you're doing. Let's go deeper now into the plumbing if you're not already in knee-deep sewage. Let's talk about the VIX. So you think high volatility always equals bad things, right? And low volatility equals a good regime. But in this twisted world of liquidity and the twisted liquidity regime, bad news can actually crush volatility. Sounds paradoxical. Well, here is the paradox. If bad news increases the odds of a Fed pivot, the market perceives less long-term risk. Makes sense, right? If the Fed is going to save us, why buy the insurance? Disregard the house being on fire because the insurer is going to pay out, right? So bad news hits. Traders sell puts, which is insurance, because they expect the Fed put. Implied volatility then concomitantly drops. When volatility drops, systematic funds, known as vol control funds, are triggered to increase their leverage. It just goes in a maddening circle, right? Do you see this feedback loop? Bad news leads to stimulus expectation. Volatility drops, vol control funds buy stocks, the market rallies. And it happens like that. It happens like that. It happens like that. I know, it's perverse. It's disgusting. But yeah, it's also beautiful, right? The worse the news, the safer the trader feels. Because Daddy Powell, Daddy Fed, Daddy ECB, Daddy BOJ, Daddy BOE is loading the bazooka in the basement and giving you a huge not rubber band, but a huge, what are those things called? A huge band-aid, right? Preemptively. There is one more macro factor here though that is away from band-aids and plasters. It's capital flows. Money is like energy. It cannot be destroyed, it can only be transferred. A bit like the funds to all of my past escapades. But we'll leave that for another video, maybe not. If we get bad news in the United States, say, I don't know, a banking scare, you might think, hey, sell US stocks, man. But where are you going to go? Europe? Have you seen the energy crisis? China? Good luck getting your money back out. Emerging markets? Too risky. The bid-ask spread is too wide, right? So bad news in the US often results in a flight to safety. I mean, recently we've seen that break down somewhat, but it's still majorly intact, right? Where does it go? It goes into US mega cap tech, Apple, Microsoft. They're treated like sovereign nations with according credit ratings as well, right? There's some tech companies out here to fund themselves in the debt markets, they're paying lower rates than actual sovereign nations. It's wild. They have more cash than most G7 countries. So when the economy shakes, money doesn't go to cash. Where it goes to big tech. It doesn't want to lose money to inflation. It wants to preserve its purchasing power in big tech. The S&P 500 is cap weighted. If everyone panics and buys Nvidia and Apple, the index goes up. Even if the 498 average stocks are in the toilet. The headline says market rally. The reality is capital flight into the monopolies, into the oligopolies, into the kleptocracies, or into the captured markets of tech. Now, before you go out to mortgage your house and buy calls for the next disaster, you need to know when this actually stops working, because it does stop. This bad news is good news mechanics. It relies on one thing. It relies on that liquidity. And that's what this channel talks about. Capital flows, liquidity, macro, and my 4 subscribers. That's what we talk about here. It works as long as the credit markets remain calm, as long as they remain ebullient, as long as they remain well supplied. The moment bad news becomes a credit event, meaning companies actually start defaulting, and bond yields spike uncontrollably, and the plumbing gets clogged, then the game completely flips, right? Like, if you're watching HYG, which is high yield corporate bonds, basically, you watch the credit spreads. If the stock market is rallying on bad news, but the credit spreads are blowing out, you need to run. That is the signal that the Fed put is well and truly dead, and the liquidation event has begun. Liquidity trumps fundamentals every time, but solvency trumps liquidity every time. So if the pipe bursts, it doesn't matter how much water you try to pump through them. So what's the lesson here other than we are all getting covered in sewage, right? You need to stop reacting to the world as you think it should be. You start trading the world as you actually see it. The market is not the judge of economic morality. It is the mechanism of liquidity discovery, and that is it. Bad news is just a signal. If dealers are long gamma, if positioning is bearish, if the Fed is dovish, bad news is a buy signal. I know that sounds perverse, but it is how it works. You need to stop reading the headlines. Start reading the flows, the capital flows. not the new flows, where the liquidity is going. Because while the retail trader is crying about the economy, the smart money is laughing all the way to the liquidity bank. And best believe they are making huge withdrawals. If you want to know exactly how to track these dealer flows, pay me $1,000. No, I'm joking. Along the way, I'm going to be building more videos like this. So if you want to see it, if you want to see the toolkit, just follow along. I don't sell courses. I don't ask for subscription. I don't do any of that. I'm just here for the love of the game, right? So that's the lesson over. Don't be the liquidity, be the predator. Class is dismissed. Enjoy your evening. Ciao for now.